When we are presented with a whole bunch of options, it is easy to fall and get into the wrong ones. Whether it is choosing what to order at a restaurant or choosing where to put your money while investing in stock markets. But unless you learn from your mistakes and correct them in time, you won't be able to grow in life. It's your chance to learn and grow or just let it go. Let's start with the question what diversification really is. This is RareXRaa, your favorite place to learn something new every day. Diversification is a tool for managing risk, which means you can either minimize or maximize your risk by diversifying in a sound way or by concentrating or spreading your investment too broadly without proper understanding of what you are doing. Now, how can one diversify their portfolio in a sound way? To understand this, we must understand what are the mistakes that investors make unknowingly while building a stock portfolio. First and the most common mistake that people make is diversifying too much. When I was young, I would buy stocks based on how I felt or what I liked on a particular day. Because of this, I ended up with more than 60 stocks in my portfolio. It was more like a kid playing around with money rather than an investment strategy. But at that time, I used to think that I am diversified too well, unlike Jack, who was a friend of mine. People buy too many stocks and think they are well diversified, but the reality is they do not know what they are doing. As Warren Buffett says, wide diversification is only required when investors do not understand what they are doing. This mistake is simple but not so easy to correct. We will talk about how to correct these mistakes later in this video. When I realized this mistake of mine, I was too attached to every single stock of mine. It was hard for me to sell anything because I had either worked hard for every investment I made or Jack was holding it too. I mean, I can't see Jack get rich and I miss out. Another mistake that people make is diversifying too little. It happens when you fall in love with a stock. See, when you fall in love, it's hard to think rationally. Jokes apart, people sometimes put a huge chunk of their portfolio in just one or two stocks without even looking at other and even better opportunities available. While putting a huge percentage of our portfolio in a single investment, being aware of what you are doing is okay. Sometimes people buy stocks that they are not aware of properly. This can expose them to unreasonable risks of long periods of underperformance of a stock or sector. You might be able to make some money using this in the short term, but in the long run, it is a risky approach. And if you make this a habit, it is going to hurt you at some point. Maybe when you are about to retire, who knows? It is time to correct your mistakes and build a habit of diversifying your investments properly. Another mistake that investors make while diversifying their investments is not considering sectorial or thematic overlaps within their portfolio. While building a stock portfolio, investors generally tend to think of which businesses or stocks they should be investing in. But this causes them to forget about sectors many times, and they end up putting a huge percentage of their portfolio in one single sector. And this generally happens when a particular sector is going through a tailwind. While investing in sectors going through a tailwind is beneficial, people tend to forget the risks associated with overallocation in a particular sector. This leads to significant underperformance of a portfolio for long periods of time when the tailwind is over or correction happening in the sector. For example, in the year 1998, Jack, who is a friend of mine, saw prices of tech stocks were all growing very rapidly and he decides to invest some part of his portfolio, approximately 10% in technology company called Microsoft. In 1999, Jack saw a whooping 100% return from the investment he made in Microsoft last year. Now he wanted to increase his allocation in the tech space because he could not see the rest of his portfolio grow slower than the tech companies. I mean, he made a whooping 100% in just 1 year in a tech stock. Slowly, he started selling his other investments and shifting his money to other stocks in tech space. The tech stocks kept going up and he kept investing more and more money as he was convinced that the big money is made in just this crazy thing called internet. Jack kept getting richer and richer. It was January 2000 and Jack had 90% of his money only in tech stocks. But all of it crashed when the dot-com bubble burst and technology heavy index Nasdaq made an all-time high on 10th March 2000 and after that it crashed close to 80%. It then took 16 years for the Nasdaq and most of the stocks to recover and come back to the same number, and many stocks couldn't even survive the crash. Jack thought he was diversified too well because his money was in many stocks and not just in Microsoft. Until after 3 more years, he came to the conclusion that it was just FOMO and he was better off with Microsoft being 10% of his overall investment portfolio. Even intelligent people make such mistakes and lose their hard earned money because they become greedy in bull markets. Understand this, it's okay to make mistakes, but only make mistakes that you can afford so that you may live to make another. Now let's talk about how to avoid making these blunders and how can we correct them if any of these mistakes sounds relatable to us. If you have made the mistake of diversifying too much, then you might want to rethink of every single stock that you have. Firstly, write down the name of every single stock you have in your portfolio on a piece of paper. Decide how many businesses you can really track. For me, this number is 20. For you, it can be 10, 20, 25, etc. according to you. Sit and analyze all the stocks you just wrote down. Now think again about every single stock and mark a cross on the ones which you do not like to hold. You will be able to discard at least a few of them. Now categorize them according to the sector they belong to. Now you will be able to understand which sector or theme you are overexposed to. Decide by analyzing again and again what do you think should work the best for you. And finally, it's time to say goodbye to some of your darlings and buy more of the stocks you think should work the best. Understand this, such process will take time, so do not be in a hurry because giving it time will help you make wise decisions. Let's move to another one. If someone is diversified too little, they should make sure that they have looked at enough opportunities within their circle of competence. I heard you saying, what the hell is circle of competence? Well, circle of competence is nothing but the area or industry you have a deep understanding. If you have looked enough and you couldn't find more opportunities to invest your money, then you might want to work on yourself by studying some of other industries. But if you have found some good stock in some other industries, but you have very little investment in that stock because of lack of money, you might want to sell your over allocation to balance your under allocation. But this is not always wrong. Sometimes people who understand a stock or industry deeply wants to put a lot of money in a particular stock or sector, maybe because they understand that there is a very low risk and a huge reward. But still, concentrating your portfolio without properly understanding is very risky. It can hurt you at times. And if you have not considered sectorial or thematic overlaps while making your stock portfolio, here is how you can correct this. Firstly, what you can do is review your portfolio and identify overlapping or concentration in specific sectors or themes. Then research the sectors you have invested most of your money in to understand the sectorial cyclicality and risks associated with it. Then you can gradually shift your money from sectors that you have over allocation in to the sectors that looks promising and show potential for growth and stability. Always aim for the perfect balance that matches your risk tolerance and investment goals. And keep learning about new sectors and keep an eye on market trends so that you can increase your circle of competence.